There are a number of strategies investors can use to try and outperform the broader market. And one way to build a successful portfolio over time is by investing in dividend stocks. Now, investors like Warren Buffett have called dividends the secret sauce to his performance. But how can a dividend plus growth formula potentially sweeten the pot for investors? On this IBD Explains, we ask, what are dividend stocks and how do they fit into an investor's overall portfolio strategy? And joining me to help break things down is IBD's personal finance and management editor, Matt Krantz. So, Matt, tell us really quickly, what are dividend stocks and how can you invest in them?
Okay, so when companies generate a profit and have a little bit of money left over, they can do different things with them. One thing they can do is put it back into the business. Another thing they can do is buy back their stock, or the last thing they can do is pay a dividend. And a dividend is kind of like free money for an investor. You basically get a check. It usually comes quarterly. And if you own a stock that pays a dividend, it's a nice little bonus that you kind of get 4 times a year.
And if I were maybe interested in playing this with a fund versus an individual stock, is there a way investors could do that?
Absolutely. So if you just buy the S&P 500 ETF alone, that owns a lot of dividend paying stocks and you'll get a yield about 1.6%. You can get ETFs that even focus even more on dividend paying stocks like SDY, and those pay even more. And some industries or sectors also own stocks that tend to own more dividend paying stocks, and those can yield, 3% or higher. And then don't forget there's a variant of fixed income. They're not technically dividends, but they're income. And those can be interesting plays too.
And I'm curious, what might investors consider when it comes to buying dividend stocks versus purchasing growth stocks?
Yeah, so it's kind of a counterbalance. So that's kind of an age-old debate on Wall Street. Some people love true, steady dividend-paying stocks because it seems more predictable. Usually, companies don't like to get rid of dividends once they commit for them. Once they sign up for them, they keep paying them. They tend to. But these companies tend to also be more mature. So these are companies that feel confident enough in their business that they know that they can keep paying these periodic payments to investors. So it's a trade-off. Typically, if you're getting a nice big dividend, you're not getting as much price appreciation in the stock.
So, Matt, how do dividend stocks then fit into an investor's overall portfolio strategy?
So the thing that's kind of nice about dividend paying stocks is they are more predictable. So normally companies are very reluctant to cut these payments. As a result, when business gets a little tough and you might see sell-offs in high tech stocks or sell-off in more cyclical names, the dividend paying stocks tend to do well. But the caveat is this year, you have the opposite happening. The growth stocks are doing great. The big cap techs are just rocking and rolling. And if you're sitting on dividend stocks, you're missing out on all that because the companies that are paying big dividends are not participating in the growth rally this year.
So then what should investors consider when they're looking at dividend stocks in terms of benefits and risks?
I kind of like the S&P 500 approach. It's kind of a mix. So they both have great attributes. So dividends typically account for 1/3 of the total return of the S&P 500 over the long term. And that's a pretty significant chunk. And it tends to really kick in during tougher times. So if the economy slows down, the dividend paying stocks really pay off. With that said, you don't want to go overboard on the dividends either, because then you totally miss out on the growth opportunity. So kind of a balanced approach really can work well with a long-term portfolio.
And when those dividend stocks do pay off, how are they taxed? Is it similar to individual stocks or how does that work?
Yeah, that really is complicated. And the answer is it depends. So there's two types of dividends. There's qualified and unqualified. Unqualified dividends are taxed at your full income tax rate. So that's kind of a rough load. So there's some strategies to put those in tax deferred accounts to kind of buffer that a little bit. But by and large, every company in the S&P 500 mostly pays what's called qualified dividends. And qualified dividends qualify for special tax treatment. That's actually pretty sweet. There's a little fact that very few people know, that if your income's low enough, you can actually pay zero tax on your dividends, which is incredible. Most people, it's about 15%, but if you make a lot of money, it can be as high as 20. So it's a nice range, but it's definitely preferred tax preference over regular ordinary income.
Now, you mentioned that more mature companies tend to offer dividends. Do they speak to anything about the health of a company, or when a company does offer a dividend, should that kind of ring an alarm bell for investors?
Yeah, it's funny. Okay, so if you're like a stable investor, it's a great question. If you're a stable investor and you want stable returns, the announcement of a dividend is like, a holiday for you. This means that the management has enough faith in their long-term business that they feel committed to this dividend. It can get even sweeter too. There's dividend aristocrat companies that have increased their dividends every single year for 25 straight years. They take this really seriously. So if you get a dividend aristocrat, you pretty much know you're going to get that dividend every single year, and it might even increase. It probably will increase. With that said, the announcement of a dividend is kind of toxic to a growth investor, because the growth investor is going to see it completely differently. They're going to say, oh my goodness, this is terrible news. This means that the company has nothing better to do than give me the money back. Seriously, there's no AI to invest in, or there's no, new emerging growth areas. So it really depends on what kind of investor you are. It can actually be great news or terrible news.
Well, it's funny that you mentioned AI, because dividends tend to be associated, as you said, with more mature companies with value investing. But it does look like a growing number of tech stocks are starting to offer dividends. What does that say about the sector, or what is happening there?
Yeah, there's a big change there. The tech industry, the tech sector is starting to really turn on the jets in terms of dividends. It's one of the fastest growing areas for dividends. Apple pays a small one, which is up from nothing, and Microsoft pays a small one as well. But some of the more established, or the more kind of speculative tech names like Amazon and Alphabet still do not pay a dividend. And so it's kind of like, I think when these tech companies get to a certain size, they start paying. IBM is another one that pays. But the ones that want to stay youthful, or kind of like Amazon always says day one, it's always day one. I really would be skeptical if they paid a dividend, because it goes against their whole thing.
Well, Matt, thank you so much for your insights today.
Thanks for having me.